Hi, everybody. This is Robert Chadwick with America Mortgages, and thank you for joining our most recent webinar. Every other week, we try to bring you something new and exciting on investing in U.S. real estate as a person living and investing from overseas. So I think you're going to be really excited about the current guests that we have for this series. I will introduce him shortly, but if you're not familiar with America Mortgages, I'll give you a quick introduction, and then Johnny from Homeroom will go, and then we will discuss a little bit more about the financing options, which on the properties Johnny is discussing, and then we'll have a short Q and answer session after. So America Mortgages is a mortgage brokerage with representation in 12 different countries around the world. Our only focus is providing U.S. mortgage financing for foreign nationals and expats. So 100% of our clients are living somewhere overseas, earning their income overseas, and investing in U.S. real estate. So let's get right into it. I'll introduce Johnny's the CEO from Homeroom. Homeroom has a very unique way of investing in U.S. real estate, which probably many people are unaware of. But Johnny is by far the industry expert in this field. So Johnny, why don't you take it away?
Sounds great, Robert. Thanks so much. Let me go ahead and pull up my slides here, and we'll go ahead and get started. Awesome. So I am Johnny Wolf. I am the CEO and founder of Homeroom. And Homeroom helps real estate investors make 50% more rent on the exact same house. There's a few homes that investors have purchased at the bottom of the screen, really beautiful, high quality properties that they're getting great returns on. So a little bit more about me and Homeroom. So I already said the first part, CEO and founder of Homeroom. I was previously a finance executive at Silicon Valley technology companies, as well as startups. I began investing in single family real estate in 2008. And in 2015, I moved to Austin, Texas to invest in real estate full time. I rented out each room separately in my properties and was able to get a lot more rents. And my friends heard about it and were really jealous, which is the number one emotion you want from your investments. And so I thought there was a big opportunity to make this model bigger. And so Homeroom was born in 2018. In 2022, Homeroom was accepted into Y Combinator, which is the premier startup accelerator in the world. They've invested in companies like Airbnb, Dropbox, Twitch, and Stripe. Homeroom has raised $15 million to date and has $100 million in assets under management currently. So let's talk a little bit about market timing in real estate. And Homeroom, one of the things we do different and better than a lot of real estate players is we have data science team on staff, and we look at a lot of historical data and timing about investing in real estate. So one of the things we've heard a lot over the last 2 quarters is it's a down market, right? And as someone that began investing in 2008, I understand the feeling. So I bought right at the wrong time that first property, but it came back up in 2012, and I did all right. But is it a down market? Are we facing something similar to 2008 right now? I think the media would have us believe that that's the case, right? That housing sales are down, mortgage rates are up. It's all a disaster, right? And you can see if you go on to any number of media locations, you'll see housing market continues to slide down in November. Housing market certain to face further drop, 10%. U.S. stocks lose ground, interest rate decisions, all this negative news. The issue with the media is that while it will catch some directional feeling of the market, it's very poor at finding specific opportunities and dissecting things. It mixes things like number of sales with property appreciation a lot. It mixes rent rate growth. And it mixes it all together in a hodgepodge of negative kind of information. But what you really want is someone that understands those nuances. And so I think here's a really good example of, it shows kind of the media. If you read some of those headlines, you think everything's a problem. But when you cut a little bit deeper and you look a bit more specifics, you can see that prices in the US in real estate have gone down as a whole on average, which is true. but it's gone down a lot in some very expensive markets. San Francisco and the Bay Area has been particularly hit hard. A lot of coastal California, Austin, Texas, Phoenix, Arizona, these have been hit really, really hard. But there's a number of markets in the United States that have not gone down really at all, right? So we're looking at some of these Midwestern markets, these markets in Florida. And so you read the newspaper, it says it's all a disaster, don't buy real estate. But then you take one cut and you look at the detail and you talk to people that are doing the data science, and you'll see that it's actually not bad in a lot of markets. It's actually maybe a great time to buy because people are all reading the same headlines. So another reason that we're not, as far as it being a downturn in the direction of the market, uh, compared to 2008 and why it's not, is that the Dodd-Frank Act was passed in 2008, and it prevents excessive risk-taking that led to the financial crisis. What happened in the financial crisis is, many of us are aware, is that a lot of bad loans were packaged together and then cut into little pieces and sold as high-quality products. That's not allowed anymore. A lot of other pieces is that lenders could pay real estate agents for deals. And so there's a lot of everyone's paying each other to create a frenzy that had people that and arm loans that, and so people shouldn't have owned homes were buying homes. Lenders were giving loans to people that didn't deserve them. And so it was a massive issue, right? And this Dodd-Frank Act prevents that. In addition to that prevention, equity in homes is an all-time high in the United States. And so at the time in 2008, a lot of the equity there was not much equity in the market. And so as the air came out of the balloon, everything crashed. Today, we see record equity. So it'd have to come down substantially to free up inventory and cause defaults. In addition to that, inventory today is at all-time lows still. So in 2006, we saw all-time high in inventories, right before the financial crisis, right before a lot of inventory even more inventory hit the market. It was already very, very high. So it remains constricted and tight. So is it a good time to purchase an investment property now? We say that in every market cycle, it's a good time to consider buying, right? And that's a lot of financial advisors would say that about stock purchasing. You buy at each market point to continue deploying capital. As markets are going up at a good pace, there's some really nice parts of that, right? So if you bought in 2020, you were able to refinance really quickly as value came in your home. But a big negative is that what we saw was happening is that it was a massive feeding frenzy. So there were homes in Austin that had 100 offers on them. So people are having to do crazy things, offer $100,000 over the list price. They would have to waive all contingencies. So they would get a lot of problems with the home because they wouldn't be able to vet it properly. Today, because of a lot of the negative sentiment, media spread by the media, as well as a lack of understanding the nuances that some markets are not being affected by this. Kansas City is not really going down very much today. People are like afraid, right? Coastal buyers don't know this in the United States. So we think it's a big buying opportunity. You can go and make a good offer at list price, not pay over asking. And maybe you're competing with one other buyer. You can do all your contingencies, your inspection, make sure the home is in great shape. So we think it's actually a really nice buying opportunity. In addition to that, while rates are pretty high, refinance in the not too distant future, we believe, is a very good possibility. So let's talk a little bit more about the product, which is what Homeroom does and what we specialize in, and how we get that 50% more rent is we rent each home by the room. And so what that looks like and what drives that is that, sorry, got my slides out of order there. What's driving the demand for what we're doing is the percentage of young people living with roommates in the United States has more than doubled in the last 40 years. 1981, it was 11%. In 2020, it was 26%. And so over the last 5 years, a lot of institutional capital has poured into this space. In 2017, 134 million was invested in room by room rentals. In 2019, that number was up to 3.2 billion. And Cushman & Wakefield forecasts this market to be 550 billion once it reaches maturity. And we're still fairly early in the life cycle of this product. It's being this kind of big movement into roommate living has been driven by major factors: delayed marriages in the United States. People are getting married in their 30s, a lot, some in their 40s. Massive student debt, which is something that plagues a lot of a lot of folks that I know, and so they're looking to save money wherever they can. And one of those is how can they save on housing, which is not affordable. So housing is not affordable in the United States, but what is affordable is renting out a room at a homeroom. And not only is it affordable for the tenant, the investor makes a lot more. So here's a property that one of our investors purchased recently. When they bought it, it was being rented by another investor for $2,000 a month to a family. We converted it into a room by room rental. And we were able to rent out 6 bedrooms for $500 each for $3,000 per month. So we got more rent for the same house. The results throughout the homeroom portfolio mirror that example I just showed. You can see homerooms cash returns are 7.6% nationwide compared to single family properties in the exact same metro that we've analyzed. We have a number of markets that have different yield and appreciation presentations. Atlanta has a 9.5% yield on average. Dallas is 6.1, and Austin is 5.2. The lower yield markets are there for a reason. It's because a lot of times we believe they have much higher appreciation potential and a lot more population growth and income growth. So what happens when you invest? Well, you would take, we say you're going to make about $26,000 per year through us with every $100,000 invested. So net worth growth. You'd invest $100,000. The passive income or yield would be $8,000 per year. And then your net worth would increase $26,000 per year. The other pieces of that net worth increase are mortgage pay downs. So you pay down the principal on the loan, as well as appreciation. So you stack that in the cash yield and you get to your $26,000 in net worth gain. Here's a real example with a few more details of a home that was recently purchased. So it was purchased for $281,000. The out-of-pocket was $103,000. The rent that they were receiving on average or have received on average is $3,059 minus the principal, interest, tax, and insurance expense. So they're making about $1,438 in cash flow per month. Then we have some vacancy estimates and some platform fees and repairs. So a net cash flow of $654. So they're making about 7.6% cash yield on their investment with an ROI of about 26.2%. Our cash yields range, we say 8%, but we do have lower in the Austin market. We have some that are much higher in markets like Atlanta. Really quick, I'm going to kind of jump you into one of our properties so you can kind of see what one of these room by room rentals and co-living spaces look like. You can see we furnish the common areas as part of the setup process to kind of increase the appeal and the length of stay with the tenants. We have smart locks on the doors. We have things for organizing mail between the groups. A lot of these homes are really beautiful. Stainless steel appliances, granite countertops, and really nice living arrangement. Our tenants stay with us for an average of 2 years. Okay, let's move to the next slide. Okay, so who is Homeroom and where are we? So we're located in 10 markets, and you can actually see that the markets, with some exceptions, we're in Austin and Phoenix as well, have weathered the downturn really well. Not big downturns in property prices. We have a team of 60 who operates these properties. We're working 24/7 around the clock and around the globe, and we have hundreds of investors and thousands of tenants. What we do for our investors, in addition to giving them great returns, is we do everything. So you come to us, we'll help you find the property, we'll help you buy it, we'll handle repairs and construction, we'll manage property and tenants, we'll provide clear reporting and support, and then we'll help you sell it top dollar at the end of owning the property. And that is all. Thank you so much for your time and appreciate you learning about Homeroom.
Thank you, Johnny. Super interesting. I think we'll probably have a lot of questions from the viewers. Let me get into our slides here. As soon as I get the prompts up. 1 second. Johnny, I think you may have to stop sharing your screen. So, yep, there we go.
You good now?
Yeah, I think we're good. Thank you. So again, thanks everybody for joining, and thank you for Johnny for a very interesting perspective on how to invest in real estate properties that maybe people would not normally think about. So some pretty interesting stuff. I think after the webinar, any questions that you have, just please drop it in the Q&A. So American Mortgages, if you're not familiar, it is U.S. mortgage loans for international clients. So basically, foreign nationals and expats that are living abroad are looking to purchase into the U.S. So why American Mortgages? Well, I mean, first, 100% of our clients are living and working abroad. We only focus on foreign nationals and expats. We have representation in 12 different countries. So, we're on the same time zone. You're not going to wind up staying up at 2 or 3 in the morning to talk to, a bank rep in New York. We handle all of this for you. If there's language issues, we speak 7 different languages. There's always some sort of cultural nuances, which, we can certainly understand. And I think one of the things that are actually very unique is all of our loan programs do not require any US credit. And I'll kind of go into this as we get more into the slides and the programs. Also quite unique, all of our loan documents or our closing documents can be signed outside of the US, meaning that a client or a borrower can open a transaction from whatever country they may be in and actually close the loan documents in a variety of ways without actually ever having to land in the US. So, I mean, this obviously was perfect during COVID and there was travel restrictions. But in general, whether you're looking to buy a property or cash out or refinance of a property, there's no need to actually travel into the US. And I think one of the things that makes us quite successful, where we have a 97% approval rate for all of our loans submitted, is we only deal in common sense underwriting. If the loan makes sense, it shouldn't matter if the borrower is in Seattle or in Sydney. The loan works, the loan qualifies, and our transactions normally complete from that. And I think as well, our loan programs are actually quite easy and simple to understand. Besides working with a lot of new investors, we also work with a lot of high net worth clients that maybe have very complicated or tax returns in multiple jurisdictions, et cetera. So we, in most cases, we do not require tax returns in order to qualify for these loans. And again, I'll go into the programs later, but I think you'll see how this works. One of the, I think, again, the unique things about the US, not just us in particular, but in general, US mortgages, there's no restrictions on age. So whether you're 19 or 99, you can increase your yields by still getting a very long tenure, which is, a fixed option of say 30 years, or we even have some programs with 40-year options that are interest only servicing for a specific period of time. And again, I think what makes us unique is regardless of the US state that you're looking in, we have loan programs in all 50 states. Next slide, Tiffany. Oh, sorry, I think we missed one. We missed one bullet point, but this is actually quite important too. And I think Johnny, as a realty representative or realtor, you would appreciate this. We are extremely transparent on any fees in the process, meaning that once the borrower applies for the loan, within 3 days, they receive a estimate of the closing cost of the transaction. The estimate that they receive has to be at or below at the time of closing, meaning when the borrowers show up at the closing table, they're not going to be surprised that they were told the fees were X and now they're Y. If anything, they're going to be less than what is initially disclosed. And our loan processors and we have loan processors in the US and we have loan officers globally. So a general overview of U.S. mortgages for American mortgages. No U.S. credit is required. No AUM required. If you're coming in or watching this webinar out of Europe, you're most likely used to having to open up a bank account and funding it with a certain amount of funds in order to qualify for a mortgage. All of our mortgages are dry lending, meaning that there is no requirement for you to have a fund with the mortgage provider. Foreign income is allowed, loan programs in all 50 states. If you're a foreign national, we can get up to 75% loan to value in all 50 states. If you're an expat, we can get up to 80%. Normally, once you submit all your documents, which I think you'll find is if you've done other mortgages, even in your home countries, it's quite minimal in the submission process, and we can get you an approval on average within 72 hours. However, we try to get it sooner than that. Closing times are as they would be in the US, even though you may be signing abroad, which is normally 30 to 45 days. Again, you can sign your closing documents in most major countries. Purchase, refinance, equity release, 30-year mortgages, regardless of the borrower's age. We have a very unique loan program, which is a 10-year interest servicing only, meaning that you're going to service the interest portion for a fixed 10 years. So whatever that rate is, that loan is going to be fixed for that 10-year period. Interest payments only. After the 10-year period, it converts into a 30-year fix, principal and interest, but without any changes in rate. So it's a really good way to forecast the longevity of the loan and what the cost would be. But as Johnny had mentioned, even though interest rates are high, or higher, I should say, than what they were, say, right after COVID, we always emphasize that you marry the property and you date the rate. So you'll always have an opportunity at some point to be able to reduce the interest rate, providing interest rates going down, but you won't always have the opportunity to buy a property when the time is right. If you try to time the market, as everybody knows, it doesn't work. And I think one of the things that we're most proud of is we have a 97% approval rate of all applications submitted. And again, 24/7 service. So regardless of what country you're in, you'll be able to reach somebody in your time zone that speaks your language. So our specialties, we can do very high value mortgages. We've done them actually slightly north of 100 million. We have mortgages without AUM. We have mortgages where there is low income and serviceability issues. And what that means basically is not that the borrower cannot afford to service the debt, because obviously that would not be a quality loan. But what it means is a lot of people may not declare their actual serviceability of a loan, which would make it very difficult to prove it on tax returns or income statements or whatever it may be. So we have a variety of ways, alternative ways to qualify the loan, say just on rental income, for example. We're very familiar with dealing with complex structures such as trusts, etc. Owning a property in an LLC or an entity is not an issue with us. And I think one thing that is actually super common now, and I think it's very easy to obtain, especially with a company like us, is bridge financing. So regardless of maybe the financial situation of the property, or you need to access capital from your asset very, very quickly, we have loan programs that go only off of the value of the property and not the current financials. So we can normally close these transactions in a week. Next. So the loan programs, we have really very simplified programs. I'll dig into each one of them quickly, and then you can have any questions, you feel free to ask after this. So our American Mortgages High Net Worth program, there's no personal income required. Again, we understand that high net worth individuals may have very complicated tax returns, multiple languages, multiple jurisdictions, etc. The personal income tax, even though potentially it may be required, it's not used to qualify for the loan. There's no assets under management required, no US credit required. We can use credit from your home country in lieu. Loan amounts from 3 million up to 100 million. You can qualify on the stock or liquid portfolio, cash, bonds, whatever you may have, with no encumbrance on this portfolio. And these transactions can normally transact quite quickly because they're not as complicated as a normal transaction. So it's normally a 30-day process. So our most common loan program is the American Mortgage's Investor Plus. What that means is, again, there's no personal income required on these loans, no US credit required. Again, we can use credit from your home country. Loan amounts as low as $150,000, which means pretty much at a 75% loan to value. Anybody can afford to invest in US real estate, especially properties, such as Johnny had mentioned, being able to increase and get higher yields than maybe what the average investor would be. On these loan programs, you are going to qualify only on the rental income of the property. So we get an appraisal for the property, we will get an appraisal survey from that. And that appraisal survey, just as it would do comparisons of the property values, would do comparison of the property rents. That amount would be used to qualify for the mortgage. So as an example, if the rental amount is $2,000, the mortgage, taxes, and insurance is $2,000, the loan qualifies. It's that simple. Next. The AM foreign investor mortgage. This is quite common. Instead of tax returns, what we require is a letter from your employer if you're employed, or from your accountant if you're self-employed. And it's a very simple letter. We have a template for it. It states 2 years of income, current year to date, and that's all we use for income. And that income will be used to qualify for the loan. And again, like all of our loan programs, no US credit is required. So if you're a US expat, you're earning your income abroad, but you don't have a W-2 or you're working for a foreign entity, all of your currency is in a foreign currency, etc. We hear this all the time. We see fallouts, meaning that loans have gone through processes with banks or large brokerages in the US to get to the very end, only to learn that, well, hey, your income is earned in the UK, or your income is earned in Canada or Singapore, or whatever it may be. We have absolutely no problem with this. All of our loan programs are expected that the borrower has foreign earned income and no W-2. We prefer that the credit score, in order to qualify for prime pricing, is at least 720. So in this particular case, if you're a US citizen, you would have to maintain US credit in order and have at least a good credit score of 720. Again, loan amounts all the way down to 150,000 and all the way as high as 5 million. The loan to value on a US expat on average is 80% loan to value. Next. The US Expat Plus mortgage, which is very similar to the Investor Plus mortgage, meaning that this loan qualifies using no tax returns and only the projected or the actual rental income of the property. Again, if you're a US citizen, we prefer that you have US credit with at least a 720 credit score. Now, we do realize as well that there may be foreign nationals, US expats that have been living abroad for many years, whether they're looking to acquire property or they still own US property and may not have credit. we can certainly do that as well, but you would actually be looked at as a foreign national when it comes to requirements. But the positive thing about this is because you still are a US passport holder, you're able to use this program in order to reestablish your credit. And again, marry the property, date the rate. As your credit is built up, you can always refinance into our other US expat programs. Next. So the services that we offer, residential mortgages, again, as low as 150,000. And really, we say 100 million, but there is no maximum depending on what you're looking to do. We have loan programs that are portfolio mortgages. You own multiple properties. It could be even across multiple states, paying a monthly check every month. It actually makes it much simpler and much easier if you can pay one check for all the assets or all the properties that you have that you put onto one loan. And that can be used for both purchases and refinances. High net worth mortgage financing, as I explained earlier, from 3 million up. Buy to let, or that's more of a UK term, but buy to let or investment mortgages. Commercial financing. So if you're looking to purchase commercial property, not an issue. Development financing, and again, asset-backed bridge financing, which is focused mainly on the value of the property and not the current borrower's financial situation. So the process is quite easy. It starts off with an initial phone call with our loan officer. You choose a loan program. This is not in stone. It can be adjusted as it goes. You provide the relevant documents for the loan program. The loan approval is normally issued within 72 hours. Again, we're trying to speed up that process, but 72 hours is still quite quick. You review the loan approvals. I mean, it could be multiple with the loan officer. You choose which is the best program. We order the appraisal. This is the only thing that will be a cost out of pocket until the loan closes. And this is all done through a third party. The appraisal is ordered. The underwriting conditions are normally issued by the underwriter, which we start to clear. And then while all of that is going on, we're arranging the signing process. The signing process can be done in multiple ways, whether you're going to the US Embassy, an apostille, meaning that you go to your local notary in your home country and you get an apostille stamp. Some states we're allowed to do a video notary. So basically you're signing on a Zoom call, or you can travel to the US or even give power of attorney to a trusted advisor. The loan funds records, and either Johnny gives you the keys to your property, or you get the cash in your account. Again, if you want it forwarded to a foreign account, that's not an issue as well. We do all the work. We negotiate the loan on your behalf. We work for you, not the bank. We are very direct and very transparent on the transactions we have. And in probably 99% of the cases, unless it's extremely complicated, there's no application fee or deposit required. So, we have over 150 onshore lending relationships. We are very private, independent, confidential, very personal and responsive team, again, in a variety of countries, speaking a variety of languages. We can work off of basic outlines. So basically no paperwork is required, but if you have an idea of what you want, what you're looking for, what kind of LTV you need, pricing, et cetera, we're happy to normally give you an idea just on the initial phone call. International coverage, very flexible terms. We have a very experienced high net worth and ultra high net worth teams. And I think you'll find, especially as if you're living abroad, it seems regardless of who you contact, whether it's a realtor or a bank or a private bank or whatever it may be, it seems to somehow come back to us in one way or another. So I think that's it for my slides. Thank you for your time. We will open up the questions and answers for both Johnny and I to share. And I think we shall start out right now. Looks like we've got a few questions. Johnny, I think this is probably for you. What market is the best cash yield?
Um, which house is the best cash yield is a better question, but we do have a number of markets that we label as like these are cash yield markets. Atlanta is really good, Kansas City, Indianapolis. With cash yield, it's interesting. If you push the lever too far down, you start to go into markets like Pittsburgh or Detroit. These would have on paper really super premium cash yields. The issue is that their population is decreasing and income is very stagnant. So a real estate investment is investment in the citizens and their income. So we generally say find the best. If you're really into cash yield, just make sure you're still in a market that is growing and has income growing. So you just want to be very careful with not chasing that all the way down to those shrinking markets, essentially. So so Midwest markets like Kansas City, Indianapolis, and Atlanta are three great examples of what I'd say is like enough growth so that you have a long-term appreciation potential and really good yields.
Good answer. Yeah, I think even for us, if we probably look at where the demand seems to be for the mortgages, it seems to be the markets that you're covering, like Texas and Florida. It's affordable to enter the markets. Financing is quite easy, and the yields and appreciation are good, if not, growing. So, another
Yeah, in
question.
addition,
Sorry, go ahead.
Texas and Florida is some really favorable real estate laws, right, for the owners. Evictions are much easier in those. So there's a reason that a lot of people, California's a tough one. Eviction's really hard, all the West Coast, but Texas and Florida especially have those great, really favorable landlord laws.
Okay, perfect. So another question, can you provide an example of an investor that was not happy after purchasing a property and renting through you and then left, and why that happened? Also, what percentage of investors stay with you?
Percentage of investors that stay with us is 98.6-ish% between 5 and 6. And sorry, I have a bit of a cold. My girlfriend just tried to give me NyQuil. I told her it was bad before this webinar. So it's a really vast majority. Most of our investors don't just stay, but they buy multiple properties. People that have left have generally left for two reasons. One is they need to access capital. We had a couple investors who lost a lot of money from crypto. And so they needed capital to kind of for their own businesses or personal use. So we had another investor who sold because he wanted to buy a condo for his daughter's college. So we've had most of our investors leave for cash liquidity reasons. We do, in the first 2 or 3 months of a property, we're doing some construction, some setup. So there can be a few folks that at the beginning part of the process, they get nervous, right? Is what's going to happen here? We're doing construction. How long is it going to take to get renters? But most of the time it works out very well. Our data science team is excellent at that.
Good, thank you. Another question, it seems a lot of questions here for Johnny. It says, apologies, I joined late and you may have covered this, but just curious, do you assist with property renovations? You mentioned that room-based rentals, which lead to higher yields, which is great. In your experience, does this result in higher variable yields as typically 1 or 2 of the roommates would be moving out versus a family that would be more consistent? Good question.
Yeah, that's a good multi-layered question. So on a monthly basis, I would say that that's true. So the cash flow for a property would vary, right? Because if you have 7 roommates or staying about 2 years, there's kind of someone always moving in and out every 3 to 4 months. We're generally pre-leasing that room 60 days. We require 60 days notice so people can be plugged right in really quickly. Occupancy is typically in the 90s percentage wise. One thing I do like to say is it's actually more stable yield wise, right? So my first investment property I mentioned that I bought out of state in Texas, I didn't have a lot of money at the time. It was my first investment, and the first renter was screened well, but they had a bunch of kids and pets, and they destroyed the property. Then they moved out, and they moved out mid-lease. They broke the lease, and I had to pay $7,000 out of pocket, which was like a lot of money for me at the time. And then it took 90 days to get the property fixed. And so I ended up being $10,000 out of pocket. It destroyed my returns for like the first 4 years. With co-living or bedroom rentals, you have stable returns. You may have one person leave. Also, very difficult for a roommate to damage the property substantially. There's other people there that are like, hey, don't like paint the carpet red like happened to my rental. So it's a more stable in terms of like, if you look at years, you're gonna have more stability, right? And you're gonna have kind of like a multifamily apartment complex. You're gonna always have some tenants. You always have income. You're not gonna have $0 months, which I think it makes it more stable. The second question is about construction renovations. Yes, we handle all construction and renovations. Our VP of operations has done 10,000 renovations in single family rentals. He came from Mind, which is kind of one of the largest players in single family home rentals in the country. So we do everything. You don't have to do anything.
I think what could be very beneficial too, we have a specialist on our team in one of our offices that focuses on not so much fix and flips, but fix and hold loans. Meaning that even if you're a foreigner, you can qualify for these mortgages, which will give you some additional equity towards the improvement of the property, which I think could be work out quite nice with the properties that you're promoting, assuming that they need to be renovated and so forth. So
yeah, we look for opportunities to find additional better yield, better returns for investors, and that sometimes means renovation. So having that capability is really valuable.
Good. Okay, another question. I believe this is for me. It says, who are your funders? Are the U.S. private lenders? Are you the direct lender? Again, good question. We work with only onshore lenders. Now, 99.9% of the time, these are not institutional banks, but these are mortgage banks. What that means is they are under the same basic requirements, but they're not deposit-taking banks. All these lenders focus on is providing mortgages. And why we work with them is because 100% of our clients, again, are foreign nationals or expats. So somebody working, living abroad, buying an investment property. So because we only work with lenders that understand these programs, all of the issues that you may have, you're certainly not going to have with us. So hopefully that answered your question. Next question, do you do non-recourse loans? And yes, we do. Anything that is or can be a bit more risky is obviously a bit more higher priced, but it is absolutely possible to do a non-recourse loan. Next question. Hi, I'm not a US citizen, and I'm wondering how long would it take to get pre-approved for a mortgage? Good question. And it's actually probably it is the first step that you should do when you start looking for a property. I mean, there's a variety of reasons, but obviously you want to see the amount that you qualify for or the amount that you're comfortable paying, and the loan programs and the payback options that are available. So you can make a wise choice when, say you go to Johnny and you're looking for a property. Normally, we can approve a loan, or we can give you a pre-approval for a loan within 24 to 72 hours. We issue you a letter, and you'll need that letter anytime that you put an offer in our property. And basically what it's telling the seller and the seller's agent is that you've already had the foresight to go through the process of getting approved for a loan. So you're not going to have this issue when you go into contract of trying to obtain a mortgage. Next question. This is for you, Johnny. How do you identify properties that have above average returns?
Yeah, so there's a couple of things we're looking at but the main one is looking at the cash flow criteria of the property. So we have a data science team that has actually millions of data points on how much a room would rent for, as well as kind of the risk factors of that price point. And so we're gonna run that through our data science and underwriting. We have an asset management team that does underwriting. And so they'll port the rent forecast into our underwriting model and provide an investor with an estimate for their cash flow as well as their long-term returns. So a lot of data work on it, and underwriting, and that's how we ensure we have good returns.
Excellent. Next question, I believe, would be for me. Could you explain more about how investors can qualify for financing using the rental income of the property, and how would that differ with the rent by room versus renting the whole house? Excellent question. So we would have to qualify the borrower on the rental income that would be listed on the appraisal that we would have to get for the property. So although you would not be able to qualify on a room rental basis, the idea behind that would be if you were to rent the property in the standard way and not, you know, a higher yielding way, the underwriter or the lender itself would have to be comfortable in providing the loan. So the positive thing would be if you qualify on this loan program, and most loans do, and you qualify just on the projected rental of the income on a long-term basis, say renting to a single person, but you're able to do this multi-room rental, your yield is only going to be higher than what you would see it on the qualifying for. So hopefully that answers your question. Next question. How do you level up from one to many properties, and what are the keys to reaching the large scale portfolios? I guess, Johnny, you could probably take that.
You know, I think I would generally say the best way to, I mean, there's a couple ways to climb the ladder to get a larger scale portfolio. Strategy one is you start with cash yield properties, and that cash yield reflects on your tax returns, and now you have more and more income, so you can qualify for more loans. The other option would be to invest in a high appreciating market like Austin, Texas. That was my strategy. Bought a number of properties there, you know, got a decent amount of equity, and so you can either refinance that cash out to invest in your next property, or you can 1031 exchange that high value property with a lot of equity in it into like multiple cash flowing properties. So there's two different ways to do it. I think it really depends on what stage of life you're at. Are you trying to level up really rapidly? In which case, I think the appreciation approach will get you there a little quicker. Or would you really want passive income from day one? Which, if you're kind of in a later stage in life, that's, I think, the better way to go.
Okay, thank you, Johnny. For you again, what is the best way to get started with your company?
The best way is to, you know, reach out to us, livehomeroom.com. We have a -- page. You can schedule a call with one of our investment advisors. It's 25 minutes. They'll talk you through some of the pieces I talked on, but they're better at it. Sharing about what Homeroom does, the benefits of what Homeroom does, what to expect in the process. And if it sounds like a good fit for you, we're happy to help. We have partners that we can connect you with if you're like, this isn't the right fit for me, as well, that are pretty helpful. And so, yeah, that's the best way to do it. Reach out via livehomeroom.com.
Thank you. Next question is what are your current mortgage rates? Very good question. You know, certainly mortgage rates are up from, you know, last year at this time. However, all of our mortgage rates are market rate. There's no premium pricing just because you know, we're focusing on this market. There's a variety of ways to qualify for the loans in the loan programs. So I think probably the best answer would be to reach out to one of our loan officers, discuss the loan program that you're looking for, and then they can go into a bit more detail on the rate options. And then you can choose which best fits. You know, again, I said, you know, we have interest only, which, you know, allows you to make the payment wise be very similar to when rates were actually less. And then, of course, when rates go down, which eventually I believe they will, you'll be able to refinance into a lower rate mortgage. So next question, what is the future of property management, and how can investors position themselves to benefit? Definitely a question for John.
I mean, you could take a stab at it, Robert, if you want.
I'm good.
You're good. Okay, cool. Yeah, it would be fun to try to answer each other's questions, I think, just to see how it goes. Yeah, so the future property management is in smart technology. 5 years ago, it was sort of seen by the kind of the smartest guys in the room to invest in real estate out of state. A little bit dicey. You had to get a partner that was probably locally based that didn't have kind of that much sophistication, right? And but with smart technology, it's enabled remote leasing to take place. So a lot of the bigger property management companies are now using remote leasing, virtual tours, like I showed in my presentation, to get leases signed without someone ever seeing the property. In our case, we don't give keys like Robert mentioned. Once you close, we actually give you a digital key code because we have smart locks. So that changes the game of property management, and over time, the expense of property management will push down, and so the expense to investors will push down. So I think the key is finding to kind of is like in moving on from the old guard, and which is like you got to have someone local, and finding someone that's using more progressive approaches. And over time, your advantage using those operators will get bigger and bigger and bigger as their technology becomes more advantageous.
Excellent. Next question is, how do I get started and where can I find the contact info? So after the webinar, you'll receive an email, which will actually be a video recording of this. It will also have everybody's contact information. So you'll be able to reach out directly either to myself or to Johnny or to any member of our teams. Next question is, what is the minimum interest rate term for your loans that you broker? I think it goes back to the question earlier. Really, the best way to answer this is to reach out to one of our loan offices, because there's a variety of ways to qualify, which will dictate how the rates are determined. So. Next one is, I'm keen on multiple cash flow properties. How does the mortgage part work with this? Very good question. We do offer portfolio loans. And I think what makes portfolio loans quite unique, at least with us, is, again, you're not qualifying on personal financials, or that's not the main qualification. The qualification is going to be on the cash flow of the properties. So as long as the property's cash flow, your loan to value can be adjusted from there. And again, depending on the size of the portfolios, LTVs can be quite high. Next question. It says, can you please speak more on commercial mortgages? What are the qualification processes like? Still DSCR? What percentage minimums required for down payments? Good question. We have a commercial mortgage team that, again, can get loan programs at all 50 states. On average, again, it depends on the size of the commercial property. Whether you're talking about buying a shopping center or a building, or you're just talking about buying a small commercial unit. The loan to values can go as high as 70, possibly 75%, depending on the actual asset and the cash flow. It does qualify on the debt servicing, as you had mentioned. So it's going to be mainly a cash flow issue and not really personal financials. But then again, it's going to depend a lot on the asset that you're buying and the size of it and the loan required. So thank you. Next question. Firstly, I just want to say thanks, Robert. You're welcome. You guys got me a mortgage with rental income qualification last year. I just want to know, how soon can I refinance the place and take out money to buy another? Is there a prepayment penalty? Thank you. So I'll have to look into, I see your name on here, so it'll be easy to look into your loan, and I will have somebody reach out to you. We appreciate your business. I don't know if there's a prepayment penalty on your existing loan or not. If there is, we can actually work out the qualifications to see if a prepayment penalty makes sense in order to cash out to be able to buy another property. If there isn't, normally in general, if you want to use the new value of the property. So as an example, say you bought the property for $200,000 and the property has appreciated, you've put a lot of money into it, whatever it may be. If you want to use the new value, you're going to have to wait. For most lenders that we work with, it's 12 months. We do have some that will go down to 6 months. But in general, it's going to be 12 months to use the new value. Otherwise, you would be required to use the purchase price of the property and any proof of the renovations that you put in to be able to give you a present value. Based on your diagram, we missed a question. Okay, we'll go to this next one while they reboot that one. On a high level, what are the potential risks one should be aware of, especially in the current house value downtrend? And Johnny, you can answer this, but I think you made a good point earlier. If you were to look at what happened in 2008, certainly this is not what is happening now. I was in the mortgage business back then, so I saw the reckless lending that was happening. It had obviously an adverse effect on the entire market. Currently, if you look at the U.S. lending, because of Dodd-Frank and other regulatory issues, it's common sense underwriting. You're qualifying, as we explained, you qualify on the rental income of the property. The loan to values are limited. So even if there was a downturn in the market, you're not going to see what it was before, where people were leveraged up, sometimes 125% of the value of the property then. That's absolutely not happening now. So I think with lack of inventory, controlled mortgages, and certainly interest rates are going up, but it also creates demand for rentals, which is increasing in higher rental yields. So Johnny, maybe you can kind of I guess expand on what I said, but that's my personal opinion.
Yeah, I mean, I wasn't in lending in 2008, so that's a pretty cool perspective. It's like an all-time world moment, right? In your front and center. Yeah, I mean, I think we've seen is that the fundamentals of real estate, and I spoke to it before, is really like the population of the city or the neighborhood and their income, right? It's just an extrapolation of that. And the US Federal Reserve, they talked about real estate prices had detached from the fundamentals. And what they were talking about is if at a certain price point, there's not enough income to support rental prices or house purchase prices. So there was definitely detachment, especially in some of these hotter markets, Phoenix, Austin, parts of Florida, most of the California coast, from the fundamentals of income during COVID. And it was just a feeding frenzy. I think people are all really bored. There was no inventory. People were all trying to find a place to put their capital because capital is so cheap. And what we're seeing right now is we're seeing some pretty big declines in those markets where the frenzy and the COVID, I think, built up tension in everyone's minds, kind of got the most attached. And I think it's not a crash. It's essentially basically taking all that detached frenzied and bringing it back down in line with where it should be, where it's just people and income. And so we're not seeing a lot of inventory. We are seeing the inventory that's out there, kind of coming back down to where it was pre-pandemic, just a little bit higher, as if there's a line of appreciation based on people's income and population. And it kind of went up and then it's coming back down. And I think that will kind of adjust out soon. And as the Fed sees okay, the prices in real estate have actually connected back to the fundamentals, I think they'll begin to kind of be less aggressive towards housing. So I think there's some risk that there's probably still room in really the markets that have seen the most deflation. And I kind of talked about it, the picture I showed, and it's really Phoenix, Boise, the ones that really were hot. I would say buying today in almost every other market, all the blues, is safe 6 months ago. It's safe now. It's safe going forward. So I would just look at prices in a market, and if they went up 25% a year or during COVID, then wait a little bit. If they didn't go up very much, you're good. The risk is, I think, nominal. but I don't have a crystal ball, but there's no inventory. So, and there's, there's more offers than there are homes. So feels like the fundamentals are pretty good in most of those markets today.
Sounds good. Okay, thank you, Johnny. I think we'll wrap this up. I think if there's any additional questions, we will answer them directly. We normally follow up with a summary of all the questions that were asked, and with a question and answer that Johnny and I will both reply, and that'll be sent out in a following email to everybody that had either signed up for the webinar and unfortunately wasn't able to make it, or actually attending the webinar. So Johnny, thank you and your team very much for joining. We appreciate the time, and everybody that joined online. We value your business and your time, and we appreciate you tuning in. And we will see you in 2 weeks with our next webinar. Thank you very much.
Thanks, guys.